Joining me now is Jason Horn from Steyn Capital Management to give us his take on the market's activity. Jason, thanks so much for your time this afternoon. I mean, the last time we had a chat, tariffs were the reason for many investors' sleepless nights, a week and some change, and now everything has shifted. We're all looking at those geopolitical tensions back under the spotlight. Equity markets pretty choppy on the back of that. Oil prices initially surged, but we are seeing a pullback. No, one thing I can say for sure remains certain is that uncertainty continues to really fuel markets action because we are back at a state of wait and see, right?
Yes, correct. I think what you've seen over the last few days is things escalate in the Middle East. You have seen, as you alluded to, quite a bit of choppiness in the markets. We kind of saw everything happen last week, and markets seemed to shrug it off at the start of the week. And then, the last few days, markets have not been a happy place, considering what's going on in the Middle East.
And one of the factors weighing on investors is the inflationary risks associated with higher oil prices. Now, the Fed didn't make mention of the tensions, but policymakers there are pegging in higher inflation, yes, on the back of tariffs. But I can imagine that policymakers are also starting to think about, the spillover from oil markets.
Yes, absolutely. I think if we look at what Fed Powell said yesterday, it was probably a bit more hawkish than the market would have hoped for in his commentary. I think what's not spoken about enough is the dual mandate that the Fed has.
Yes.
So full employment as well as prices. So while at the margin we may have seen a slight softening in labor statistics over the last few months, the jobs market remains resilient, and inflation, to be fair, still well above what the Fed is targeting. And you combine that with the tensions in the Middle East, the higher oil prices we have seen, the likelihood of the Fed cutting rates in this moment is quite low. And yes, if we look at the projections and the Fed dot plot, something that was quite interesting to note, that 7 of the FOMC members actually forecast no interest rate cuts for this year. And that's kind of what we saw, the reason for the sell-off late in the session yesterday in the US.
Quite interesting, particularly because we know that many central banks across the globe really do follow what the Fed does, and markets had already priced in 2 cuts for the year. Let's move over to what's been playing out in the currency scene. As risk appetite, of course, wanes, we've seen the rand lose most of its gains, back above the 18 rand mark to the dollar. And I guess just a reminder of how liquid emerging market currencies are, right?
Yes, absolutely. And I think the rand in particular is probably the one that people look at as the EM proxy. And very much so when you look at the currency markets, in the EM space very much will give you an indication of what risk appetite is at the time. And just given all the uncertainty in the Middle East, you have seen this in the currency market, at least, this flight to safety. And whereas while the dollar has still, if you look at a longer term chart, been weak, the last week or so it has seen a bit of a resurgence as investors park their cash in dollars and kind of apply this wait and see approach.
With the rand at 18.05 and oil prices where they are, I can just imagine what we're going to see when it comes to fuel prices in the coming months, and perhaps what Kganyago could say at the next meeting in July if these tensions don't subside. Is that a concern or something you're also thinking about?
Yes, absolutely. I think we mustn't forget that the inflation data that came out earlier this week, still in and around the 3% level. So that's all looking good. But at the same time, if we combine that with the potential new inflation target rate, it probably means that, from a South Africa perspective, we are probably not going to see very many more cuts as well. So from a broader economy perspective, we're going to be looking at consumer being under a lot of pressure going forward.
All right, let's take a look at what's playing out on the company news front. An update out from Standard Bank this afternoon. The group performing well in the first 5 months of the year, with HEPS coming in higher. Just your assessment on that update, Jason.
Yeah, sure. I think, with the earnings being up 10%, it's tracking slightly ahead of the analyst expectations. The guidance is broadly unchanged. Obviously, a stronger first half versus the second half of the year. I think something interesting to note is that, approximately 40% of the earnings come from the rest of Africa. And looking at the operating environment and outlook, sub-Saharan Africa is projected to grow just under 4%. As I alluded to, being such a large component of Standard Bank's earnings, they do have the largest Africa exposure of all the banks in South Africa, and they do stand to benefit from this. I mean, we've got a big team of analysts who cover Africa, and they're in constant contact with a lot of these local banks across the continent. And based on the feedback that we have had, we do think the longer term outlook for the continent is actually quite positive.
And just quickly, before I let you go, Stadio seems to be on track with the construction of its Durbanville campus. Stadio really banking on, a higher demand for private education. And we've really been seeing that playing out throughout the past few years, even when you look at the last results. That sector really seems to be defensive here at home, Jason.
Yes, absolutely. Look, I think the update is a very solid read. Distance learning still remains quite dominant. It's 86% of the student base. But what's very encouraging is the contact learning seeing an 11% increase. So it does suggest this recovery post-COVID is continuing. And it's validating their efforts to strengthen on-campus offerings.
All right, let's hit pause on the conversation before we move on to your stock pick. Let's take a moment to touch on what your industry peers find interesting.
I'm actually going to be the guy that say, time to maybe have a look at Sasol. So,
okay.
I think we talked about headwinds upon headwinds about a few companies in the show today. We mentioned their likes of the MTNs, likes of Braids. But Sasol is really one of those companies. It's been struggling. And we know why. I mean, they had quite a bit of debt bar. They've really struggled with the Lake Charles investment, and that seemed to be under control now. There might be some interest in that regard. We've seen the oil price kick up a little bit. We know that oil price was still very recent, trading at the $60 levels, and that's not good because Sasol, I mean, let's call it, they break even on the oil side. It's about $58. Yeah. Now I know they've already mentioned at their recent Capital Markets Day that they let's call it targets by financial year end 2028 is to bring that down to $50. And actually, this massive kick in the oil price has now sort of put a new view on Sasol. And I think this might just be one of those hedges for if things escalate even further geopolitically, they might just be one to have a look at.
With Valterra, previously known as Amplats, you've seen the platinum price kick up, from just around 1,000 to 1,250 thereabouts. I think outside of the Anglo stable, this one could do well. It's not for widows and orphans, but I think the next 2-3 years look quite exciting for the platinum producers, and I think Valterra is well placed for that.
So Graham and Skalk really taking a risk on commodities, one being platinum and the one being oil. Sasol and Valterra, your analysis on that?
Yeah, look, maybe to start with Sasol, the current short-term factors are certainly helping near-term earnings. But the company does have intractable problems over the medium to long term. Mozambique gas is running out, and it's impossible for them to maintain current gas to liquids production under upcoming environmental law changes. Valterra, a horrible name, but an interesting stock. Something we acquired a stake around the time of the spin-off from Anglo, when it was depressed due to technical factors. Given its low cost base and the non-PGM complementary products, it's a lower risk way to play the PGM theme. And look, it also has a super long resource life. So it's something that we think should trade at a premium.
All right. So where are you seeing opportunity at the moment? What's your stock pick?
Our stock pick is 91. It's a business trading at about 6 times EBIT. 2/3 of its exposure is to emerging market funds, and we are seeing more interest from foreign investors in emerging markets as investors begin to look to allocate capital to markets where valuations are more interesting. So as a result, those flows, as they increase, 91 stands to benefit from this.
All right, Jason, thanks so much for your time and taking us through trade at midday. That was Jason Horn from Steyn Capital Management.